The world economy is currently running an experiment that has never been tried before on this scale. We are attempting to reconcile infinite mathematics with finite physics.
That sounds like a philosophical problem, not a financial one.
It is entirely financial. In fact, it is the defining financial issue of our decade. On one side, we have a monetary system based on debt, which can be expanded without limit. You can always print another dollar, another euro, another yen. The supply is theoretically infinite.
And on the other side?
On the other side, you have the physical world. Resources, energy, gold, things that require work to produce. These are governed by thermodynamics, not central bank policy. And right now, these two systems are colliding.
So this presentation is essentially the crash report of that collision.
Exactly. It charts the structural failure of the paper market and the inevitable return to hard assets. This isn't about speculation or day trading. It is about the fundamental architecture of value.
Let's get into the evidence. I am looking at the first image here.
Yes, let's look at page 1.
The title is stark, the thermodynamic floor.
This concept is the foundation of everything we are about to discuss. A floor usually implies a price level that an asset won't fall below because of buyers stepping in. But here, we are talking about a physical floor.
Meaning the cost of production.
Meaning the energy cost of production. You see, fiat currency has a near zero marginal cost of production. It costs practically nothing to type an extra zero on a digital ledger. But gold has an energy cost that cannot be cheated. We call this the thermodynamic floor because the price of gold cannot stay below the cost of the energy required to extract it for very long. If it does, the mines shut down, supply collapses, and the price is forced back up.
So while central banks can control the price of money, they cannot repeal the laws of physics.
Precisely. And that disconnect is creating massive distortions in the data, which we can see clearly moving to page 2.
This is a chaotic table. I see rows for XAU, which is gold, BTC for Bitcoin, and a lot of large numbers.
It looks chaotic because it represents a system in disarray. Look at the column labeled debt. You see numbers in the tens of millions, hundreds of millions. But the most important line is near the bottom. It says leverage, infinite.
Infinite leverage. That sounds like a recipe for a disaster.
It is the definition of our current banking system. When you have a fractional reserve system that has been pushed to its absolute limit, the leverage becomes effectively infinite. The system is expanding its balance sheet. You can see that notation there as well, attempting to paper over the cracks.
And the other rows, I see gold and Bitcoin listed against the USA dollar.
These are the pressure valves. As the leverage in the fiat system goes to infinity, the value of finite assets has to adjust upwards. This table is showing the early stages of that repricing. It is the market trying to find a new equilibrium between a numerator that is exploding and a denominator that is fixed.
You mentioned the denominator being fixed. That brings us back to the physics argument.
It does, and page 3 breaks this down into the raw science.
The headline here is energy cannot be printed.
This is the argument that ends the debate. You can print a receipt for energy, which is what a dollar bill essentially is, but you cannot print the energy itself.
I see a note here about intrinsic value, equaling stored energy.
Think about a gold bar. It is not just a shiny metal. It represents thousands of hours of labor, diesel fuel, electricity, and heavy machinery. It is a battery of stored economic value. The slide mentions comminution.
Comminution, that is the crushing of rock, right?
Correct. It is the process of turning boulders into dust to find microscopic particles of gold. This process alone consumes about 36% of a mine's total energy use. In some operations, The energy intensity is up to 1,420 kilowatt-hours per ounce.
That is massive.
It is. And here is the kicker. Ore grades are declining. We have mined all the easy gold. Now, we have to process more rock to get the same amount of metal. That means the energy input is rising non-linearly.
So, if energy costs go up, the floor you mentioned on slide 1 goes up with it.
Exactly. The intrinsic value is rising because the thermodynamic cost to bring it into existence is rising. Meanwhile, the cost to produce $1 remains zero.
And that divergence is what drives the flows we see on the next slide.
Let's turn to page 4.
This looks like a global flow map. We have a globe with arrows moving from west to east. The text mentions the debt engine and a system status of critical.
This map visualizes the great migration of capital. For decades, the flow was relatively balanced. But now, we are seeing a massive shift of physical gold moving from Western vaults to Eastern reserves.
The text highlights net interest payments at $921 billion for 2024. That is almost $1 trillion just in interest.
That is the debt engine consuming itself. When a government spends more on interest payments than it does on its military or health care, it has entered a debt trap. The only way out is to print more money to pay the interest, which creates inflation, which drives up interest rates, which increases the interest payments. It is a doom loop.
And the response from the rest of the world. I see central bank buying listed at 1,045 tons.
That is the highest level of buying we have seen in decades. Central banks are looking at that $900 billion interest bill and realizing that the USA Treasury bond is no longer a risk-free asset. It is a certificate of confiscation through inflation.
So they are swapping, as the slide says, inside money for outside money.
Correct. Inside money is a liability. It exists inside the banking system. Outside money, like gold, is an asset that exists outside the system. It is nobody's liability. When the system status goes critical, you want to be outside.
But this isn't the first time the system has been reset.
No, it isn't. And page 5 takes us back to the source code of the last reset.
This contrasts 1933 with 2025. On the left, we have the confiscation. On the right, the restoration.
In 1933, President Roosevelt signed Executive Order 6102. We see the snippet of the order there. It seized private gold to devalue the USA dollar. They took the gold at $20.67 and then immediately repriced it to $35.
Effectively stealing the purchasing power from the citizens to recapitalize the government.
Precisely. It was a forced system reset. But look at the right side. 2025, Basel Roman III.
This mentions a risk weight of 0% and asset class Tier 1.
This is the restoration. For decades, gold was considered a Tier 3 asset by global regulators. It was treated as risky. But under the new Basel Roman III agreements, gold has been reclassified as Tier 1 capital.
Which means
that for banking purposes, gold is now legally equivalent to cash. It has zero risk weighting. This is a structural preparation for revaluation. The regulators have quietly built the framework to allow gold to sit at the core of the banking system again.
So 1933 took gold out of the system, and 2025 is putting it back in.
Yes, but there is a catch, which brings us to the next slide.
Right, page 6. This is titled The Glitch.
A glitch is a system error, and right now, the global monetary system has two major bugs. Bug 1 was the sanction risk introduced in 2022.
That refers to the G7 freezing Russia's reserves.
It does. That moment changed history. It proved that foreign exchange reserves, dollars, euros, are not yours. They are permission slips. If you annoy the issuer, they can revoke them.
The slide says gold became the only neutral asset.
Because you can hold it in your own vault. No one can freeze a bar of gold sitting in Moscow or Shanghai. But then we have bug 2, the NSFR penalty.
Net stable funding ratio.
This is the paradox. Basel Roman III made gold a Tier 1 asset, encouraging banks to own it. But the NSFR rules assign an 85% required stable funding factor to it.
In plain English,
it means if a bank holds gold, it is penalized. It has to hold expensive long-term funding against it. So regulators are saying gold is money, but also don't hold too much of it.
The slide calls this a system error that resolves only through price.
Exactly. If the price of gold rises significantly, the penalty becomes irrelevant compared to the gains. The binary code at the bottom of the slide represents the digital system trying to process an analog reality. It is failing. The only way to clear the glitch is for the price of the neutral asset to rise high enough to balance the risk.
Which leads us to the final conclusion.
Let's look at page 7. The horizon.
We have two numbers here, $251 trillion in global debt and 9,106 tons in London. Vault inventory.
This is the math problem. The slide calls it the mathematical inevitability, revaluation of the collateral.
Explain that.
You have a pile of debt that is $251 trillion high. That debt is collateralized, ultimately, by the faith in the system. As that faith erodes, you need a new collateral. You need a base layer.
And that is the gold.
That is the gold. But at current prices, that pile of gold is too small to back that mountain of debt.
So you have two choices: shrink the debt or expand the value of the gold.
And shrinking the debt means a global depression and default. Politicians will never choose that, so they will choose option 2. They will let the price of gold rise.
Revaluation.
Revaluation. If you reprice gold to $10,000, $20,000, or $50,000 an ounce, suddenly that small pile of gold becomes valuable enough to shore up the balance sheets of the central banks.
Just like Roosevelt did in 1933.
Just like 1933. The slide mentions the collision of infinite math and finite physics. The physics, the 9,000 tons, cannot change quickly. It takes 10 years to open a mine. So the math, the price, has to change.
So the winners are the ones holding the finite assets.
The winners are the nations and individuals who own the thermodynamic floor. The losers are those holding the infinite paper liabilities.
It seems the transition is already underway.
It isn't just underway. It is structural. It is 1933 in reverse. We are moving from a world where credit was money back to a world where assets are money. And the price signal we are seeing now is just the market waking up to that reality.